I welcome you all for the online class of business studies. As we in the last class, Saturday's class, we have attended the equity shares topic. Today we will be going to start the new topic of that same chapter, that is preference shares. Preference shares, when we talk student, this is considered as preference share because the first right over the dividend after paying off to all the creditors and making all the liabilities payment, the first part of the dividend which goes is to the preference shareholders. That's why the name is preference shareholder. They are having the two rights over the equity shareholder. Very first in the payment of dividend, second at the time of winding up of the company also, the part of the capital will be first given to the preference shares, then the rest part will be distributed among the equity shareholder. Because of that, they will be having they are considered as preference shares. Now when we will go to the features of preference shares, the very first feature of preference share is their very first fixed rate of dividend. Yes, definitely the preference shareholder get a fixed rate of dividend before paying dividend to equity shareholders. So there is always a fixed rate of dividend to be paid to the to the preference shareholder. They will not be getting. It means even if the surplus profit take place, then that part of that time also they will be getting a fixed rate of dividend. They will not be getting the benefit as equity shareholder. Second feature of the preference share is no security. Company do not offer any security against preference shares. The preference share capital is a part of the owner's fund capital. Voting rights, when we see the preference shareholder do not get any voting rights under general conditions. However, the preference shareholder get voting rights if the dividends are not paid for 2 years or more. So they are not having any voting rights. Next, hybrid security. Preference shares are called hybrid securities, as these shares have the features of equity shares as well as features of debentures. Like equity shares, preference shares get dividend only when company is earning profit, and like debenture, preference shares get a fixed rate of return. So they are considered as hybrid security because they enjoy both the things, as they are getting the they have the features of equity shares as well as the features of debentures. Like equity share, they will share the dividend, whereas like debenture holder, they will be getting a fixed rate of return. Types of preference shares, when we will be learning, there are following types of preference shares. The very 8 are there. The very first is the cumulative preference shares. When we learn about the cumulative preference share, the type of preference shareholders which are getting the part of the profit of the loss year also accumulated in the profit year, it is known as cumulative preference shares. It means the year when the company was having loss, they were not paying the dividend in that year, but this preference shareholder will be getting that year part of profit also in the next coming year when the company will be earning a profit. So the preference shares on which dividend gets accumulated are known as cumulative preference shares. It means they get dividend whenever company is earning profit. In case of cumulative preference shares, the dividend get accumulated for the year when the company is not earning profit, means loss year. And this accumulated dividend is paid in the year when the company start earning profit. For example, if a company is having loss for 2 years and in the third year it earns profit, the cumulative preference shareholder will get dividend for 3 years then together in the third year. Non-cumulative preference shares, when we see the type of preference shares on which dividend does not get accumulated, are known as non-cumulative preference shares. This shareholder get dividend only for those years when the company is earning profit. Means they will enjoy like the equity shareholders, they will be getting the part of the profit only in the year when the company is earning profit. The year when the company has lost, that year any dividend will not be paid to the in the form of cumulative in the next coming profitable years. Participating preference shares. Participating, as the name is there, they can participate in the surplus profit of the company. Means, as I already said, these preference shares are getting a fixed rate of dividend, but some of the like participating preference shareholders are having the rights to get the part of profit from the surplus profit. As the surplus part of the profit is going to the equity shareholders, no rights over the preference shareholders. But if the preference shareholder is participating preference shareholder, then they will be getting the surplus profit of the company also participation. That's why their name is given as participating preference shares. Preference shareholders get a fixed rate of dividend in case of surplus profit is left. After paying fixed dividend to preference and equity shares, the participating preference shares get a share in that surplus profit. Non-participating preference shareholders, when we see the preference share when which get a fixed rate of dividend only are known as non-participating preference shares. These shares do not get any share in the surplus profit left after paying fixed rate of dividend to preference and equity shareholders. Redeemable preference shares. When we talk about redeemable preference shares, as the name is there, redeemed, paid back. The preference shares which are redeemed, paid back on expiry of a fixed period of time are known as redeemable preference shares. These shares are redeemed by the company after giving notice as per the terms of issue. The provision of Companies Act hath laid down that preference shares must be repayable within 20 years from the date of issue. So after 20 years, if anyone wants the money back, they will be paid back. That type of agreement is made between the preference shares and the company. So according to Companies Act, they will be paid back within the 20 years from the date of issue. Irredeemable preference shares. It means they will not be getting any paid back. They will be throughout the life of the company. In between, they cannot paid back for the amount which they had invested. They will be getting money after the winding up of the company only. There are the preference shareholders who are throughout the life of the company. So that are known as irredeemable preference shares. The preference shares which are not redeemed, paid back during the lifetime of a company are known as irredeemable preference shares. These shares are refunded only at the time of winding up of the company. Convertible preference shares. When we talk about the convertible preference shares, the type of shares, preference share which get converted into equity shares on expiry of a fixed period of time are known as convertible preference shares. After converting, the preference shareholder get all the rights of equity shareholders. Non-convertible preference shares, when we see the preference shares which do not get any converted into shares, equity shares are known as non-convertible preference shares. Such shares remain as a preference shares only throughout the lifetime of the company. That is known as non-convertible. So convertible preference shares are having the benefit because after a fixed period of time, they can get converted into equity shares and they can enjoy all the rights what a equity shareholder are enjoying. So that is about convertible preference shares. Non-convertible, they will not enjoy, they will be having only the rights of preference shareholders. Advantages, let us see. After learning the types of preference shares, as I said, 8 are there. One is cumulative preference share, second is non-cumulative preference share, third is a participating preference share, fourth is the non-participating preference shares, fifth redeemable preference shares, sixth irredeemable preference shares, seventh convertible preference shares, and the last 8 is the non-convertible preference shares. Advantages, when we will see there are the following advantages of preference shares. Very first, help to collect large amount of funds. The preference shares help to collect a huge amount of fund because cautious investors and financial institutions prefer to invest in preference shares of a company. They want a fixed rate of dividend, not too much they are having, not too less they want. So preference shares attract more public due to fixed rate of return. No fixed liability. Dividend to preference shareholder is paid only when the company is earning profit. So there is no liability for the company to pay them the dividend on the lost years, and to dividend has in the case of loss and borrowings. No interference. The preference shareholder cannot participate in the management activity. They do not have having any voting rights. The presence of preference share does not diffuse the control of equity shareholder. The whole control will be with the equity shareholders itself. With preference shares in capital structure also, the equity shareholders retain exclusive control over the company. No charge on assets. Preference shares are not issued against any security. The assets of the company remain free to be offered as security for loans and borrowings. So there is no charge on assets. Variety, when we see, a company can issue different types of preference shares according to the need of the investors and interest of the company. So there is a variety in the preference shares. Trading on equity. The rate of dividend on preference shares is fixed. Hence, in years of prosperity and more profit share, equity shareholders enjoy high rate of earnings with the presence of preference shares in the capital structure. So trading on equity is an advantage. The rate of dividend on preference share is fixed, so more if surplus profit the company is earning, that profit instead of giving to preference shares, as they are getting fixed rate of dividend, the company can utilize it for investment in other activities. Variety has it say different types of preference shares are there. There is a choice for the company to select the best type of preference shares for their interest of the company. Demerits, when we talk the disadvantages of preference shares, there are certain limitations of these sorts of finance. These are fluctuating and low return. The preference shareholders get return only when a company is earning profit. The return on preference shares is generally low and lesser than the rate of interest on loan. The preference shares do not attract many investors as there is no assured return. Dividend is not treated as an expense. The dividend paid to preference shareholders by the company is not treated as an expense. It is not deducted from the income of the company before calculating income tax. The company pays income tax on the income which is distributed to preference shareholders. No voting right. This is also a disadvantage of preference shareholder because they are investing money but they cannot participate in the management activity. The number of preference shareholders are more in the organization but still their decisions is not important. The preference shareholders generally do not carry any voting right. This shareholder have to say in the no say in the management. The shareholders get voting rights only on any resolution regarding winding up of the company or repayment or reduction of share capital. Fixed obligation. The rate of dividend paid to preference shareholder is fixed. During time of low profit, also a company has to pay a fixed rate of dividend to its preference shareholders. Difference between equity shares and preference shares. Let us see equity shares and preference shares, student. When we see, it is very important to distinguish between the face value. The face value of equity share is generally low. The face value of preference share is generally high. The price value of preference share is generally high. Dividend. The dividend is paid to equity shareholders after paying off all the creditors and all the liability holders. The rest part of the dividend is paid to the equity shareholder. It means residual income. Preference shares, they are having the right after paying to all the creditors and the people. The rest part of the dividend will be given. The first part of the dividend will be given to preference shareholder. Voting rights. Equity shareholders are having a voting rights to participate in the management activity, whereas preference shares do not. Attraction. The equity shares attract bold and adventurous investors, means those who are having more interest in shares and want long-term profit, whereas preference shares attract cautious and conservative investors, means they want to invest in the share but they are not, they don't want any type of risk. They are very cautious type of to take step in for the business. Risk. The equity shareholders are primary risk bearers of the company, but risk involved in preference share is relatively less. That is fixed up to the share amount. Refund of capital, when we say at the time of winding up of the equity shareholders, equity shareholders are refunded only after preference shares are paid. At the time of winding up of preference shares, get priority over equity share for refund of capital. So winding up, equity shareholder will be getting the rest part of the capital only after paying preference shareholders and other creditors. But preference shareholder will be getting the first priority. Redemption. The equity shares are never redeemed or paid back during the lifetime of the company, whereas preference shares may be redeemed on expiry of a fixed period of time or at the option of the company. Debentures, bonds, borrowed fund. The next topic of the chapter. Bonds, when we see, students, it is an agreement between the company and the particular debenture holders on the basis of trust. They make the agreement that after a fixed period of time they will pay back the money. So debentures are common securities issued under borrowed fund capital. Debentures are instruments for raising long-term debt capital. Means it is a borrowed fund. Okay, debentures are called creditorship because they are treated as creditors of the company. They do not participate in the management and they will not consider as the owner of the company. So they are considered as debenture holders are also called as creditors of a company. A debenture can be defined as a document of title or a certificate issued by a company under a seal or an acknowledgement of its debt. Holder of debenture certificate is called debenture holder. Features, characteristics of debentures, when we see, it is very first borrowed fund. Debentures are part of borrowed fund capital as debenture holders are considered as the creditors of the company. Fixed rate of interest. Definitely, as creditors we pay the fixed rate of interest, same way debenture holders also the interest on debenture is paid at a fixed rate. The rate of interest is decided in the annual general meeting of the company. Compulsory payment of interest. Definitely payment of regular and fixed rate of interest is a legal obligation of the company. Company has to pay interest to its debenture holders irrespective of its profit sharing earning capacity. Security. From security point of view, when we see, most of the time debentures are issued against the charge of some fixed assets of the company. Redeemable security said a company mortgage assets, and if the company is not able to pay back, then debenture holders can claim over the securities of the company. Redeemable debentures are always redeemed to or paid back on expiry of a fixed period of time. No voting rights. Debenture holders have no say in the management activity, as they are never granted voting rights in the company. Appointment of trustee. When a large number of debentures are sold to the general public, then usually a trustee is appointed. Trustee can be a bank or a financial institution. Trustee is appointed to ensure that the borrowing firm fulfill its contractual obligation. So this was for today's class, students. I hope you have understood, and I hope you have started your project was also. As I said, before the first midterm, you have to submit the project, you have to start up the project. As I suggested for business studies, the insurance topic, which is more easy for you people, as you learn now only. For the midterm also it will be useful. So make the project on insurance, or otherwise the research study on the various fruits from various areas that you can do. So for this was for today's class. Have a nice day. Thank you.